Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 in my 5-part series on the company George Risk Industries, symbol RSKIA. Today we're going to talk about the company's operations. And when I look at a company's operations, what I'm trying to do is determine the quality of job that the management does in efficiently delivering goods and services to the customer, which really means how well is the company utilizing its resources to make as much money as possible. The first thing that I look at when I look at any company is the company's gross margins. The reason I do that is because I think gross margins are a wonderful litmus test for whether the company in question is a consumer monopoly or is a commodity business. Generally speaking, consumer monopolies have strong margins that are relatively flat over time. And when you compare that to commodity businesses, they tend to have gross margins which bounce around based on the price of the commodity they're selling. So when you look at George Risk Industries, you can see the green line here is the top 25% of all companies. I don't really like to invest in companies whose gross margin is much below 40%. And you can see here that this gross margin for George Risk Industries is very, very flat and significantly above the 40% line. So this is probably based on high margins and relatively flat, a consumer monopoly versus a commodity company. Next, we look at a company's earnings and we juxtapose that versus earnings per share. Oftentimes the charts for earnings per share and earnings will look slightly different because the company is either issuing shares or buying back shares. Obviously, we want companies that over time are buying back shares, and that means that the earnings per share, if it's going up, should be going up more steeply over time, which is gradually what's happening in this company, but not dramatically. Long story short, the earnings have been growing really since 2009 with a couple of interim bumps in there. Obviously, as usual, we rule out whatever happened in 2020 or 2021 because that was the year of COVID and unique and strange things happened for that year. So I sort of just pretend that year didn't happen. And if I look at it as if the continuation between 2020 and 2024, you see it almost went straight up. Slowed down a little bit in 2025, but not enough to worry about. That's why we're getting this company at such a good bargain, because they didn't the profits haven't gone up every year, but generally speaking, they go up, and that's what got me interested in the company. The next two charts, the one on the right is looking at revenues and looking at net earnings, and you can see the revenues are going up every year. Last year, the net earnings went up slightly less than revenue, but they're still going up pretty much in lockstep, and that's what we want to see. Also, when you look at the slide on the left, what we're looking at is net earnings as a percentage of revenue, and you can see that they're amongst the best companies in terms of that. They're very, very high in terms of converting dollars to net profits. And the company has gross margins, and that helps, but the rest of it also means the company is being run very efficiently in the way that it's run in terms of the 4 taxes, which we're going to talk about in the next slide, as well as interest payments, which the company has no interest payments. Another thing to keep in mind here is that one of the reasons this is so high is because for this business, net earnings are artificially high due to the fact the company has $40 million in cash on an $80 million business, and that cash is generating interest income, which shows up as net earnings, although it's not an operating earning. When I talk about a business and their operations, the first thing we want to worry about is gross margins, because that measures the ability to sell a product for above the cost to manufacture it, which is a sign, as we've said, of a consumer monopoly. But once you've decided that it is a consumer monopoly, you have these, what I call the 4 taxes. There are 4 things that a business typically needs to spend money on, and the amounts they spend are different depending on your industry. So for example, if you're a pharmaceutical company, you're going to have really high research and development costs. If you're a manufacturing company, you're going to have higher inventory costs. And every company typically has some component of these 4 taxes, and then they don't have other components because it's just not important to their industry. For example, a software industry almost never has inventory because the product they're selling, software, doesn't require any inventory to sell the product. So let's go through the first 2 of the 4 taxes. Selling and general administrative. That's just the cost of getting people to buy your products and all the admin that goes along with running the business. You can see that this company is above average, but not in the top 25%. That's fine, not every company is. Obviously 75% of companies aren't, but it's very stable. It's actually lower than it has been. That shows that this company is doing a pretty good job in terms of general administrative, and it's not an area of concern for us as shareholders. So long story short, it gets a good grade here. I probably gave it a 3 because it's been coming down gradually. Plants and equipment as a percentage of assets for this company are very, very low. Again, one of the reasons for that is because they have $40 million in cash, and that's an asset which doesn't have to do with plants, property, and equipment. So long story short, they're in the top, 85 or 90% of companies in terms of this category. That's wonderful, especially when you consider that they're a manufacturing facility. So they typically will have higher plants and equipment costs because they need it as part of the manufacturing. In this case, they own their warehouse. They've owned it for a long time. They're in a small city in Nebraska, and all that probably helps. The next two things we'll look at is R&D and inventory. The good news is research and development for this company is almost zero. They spend nothing on that. I'd actually like to see them spend a little bit more to try and develop new products, but that's not my job to do as an investor. But one of the big problems with this company is they have very significant amounts of inventory, and I can't imagine why they need that many. I'd like to see that inventory come down. That would be money they could give back to the shareholders, money that's not at risk for inventory becoming obsolete. But it does look like they've lowered this each of the last 2 years. Hopefully that's a trend that can continue and even accelerate. But having said that, I suspect that, and I've talked about this in the first video, I suspect they've got caught flat-footed during COVID with not being able to get inventory, and they've simply decided that's not going to happen again, and so they're overcompensated. But having said that, even before COVID, this number was still high. So I'd like to understand why there's so much inventory in this business. Again, it's not enough to make me not want to look at the company, not buy the company. We bought the company knowing that this was the case, but no company is perfect. And if you want to look for an area to improve, I think inventory might be where you could do that. We're not going to spend much time on interest payments because the company has no debt, and as a result, they pay no interest. So that's obviously wonderful. And that, coupled with where they stand on the other low taxes, the no property, plants, and equipment, the no R&D, the relatively low selling and general administrative, when you combine those three with the fact that it's a little bit high in terms of inventory, that's a ratio that we can accept, and we're pretty comfortable with the way this company handles operations. So the summary of the operations, I look for companies with growth margins of at least 40%. This company has been basically between 48 and 52% since 2006, so very, very flat and very, very high. So that's the definition of a durable competitive advantage. If the gross margins aren't changing, that means they're not being outcompeted or people aren't coming out with new innovations that are beating them. The earnings have been down for the last year, but that's basically after 5 years of an upward trajectory. I'm okay with one bad year. That's kind of the only way we get to buy these kinds of companies, because if everything was sunny and positive, the PEs be too high and I wouldn't be able to buy them. Net earnings as a percentage of revenue is very high, but again, that's probably jaded because the net earnings include investment income, and that's not the same thing as operations. The R&D and plants, property, and equipment are both near zero. Selling and general administrative is relatively flat and consistent, but inventories are really high. So I'd like to see that number come down. But that's basically it for operations. This company is extremely well operated. I have no complaints. Obviously, there's always, constructive criticism somebody could get, and if there was any in that company, this company, it would be the inventories. But that's all I got for operations. Thanks.